Silver closed at $67.38 on December 19, 2025. That's not a peak. That's a fracture line. Physical premiums in India hit 17% above spot. Refiners report zero inventory for the first time ever. And COMEX vaults lost 60% of registered silver, 47.6 million ounces, in just 4 trading days this month. Meanwhile, 128.6 million ounces, borrowed by JP Morgan from China's ICBC, must return in early January, exactly when Beijing enforces export quotas on 60 to 70% of global supply, and LBMA delists non-Roman marked bars. The math doesn't add up. Global registered stocks at 130 million ounces, yet demand's colliding at over 200 million in weeks. This isn't volatility. This is the system buckling under claims that exceed metal. Right now, as markets reopen, the gap between paper price and physical access is widening, signaling a break that's already in motion. Look at the delivery notices stacking up. On COMEX, 62.47 million ounces demanded for physical handover this December alone, a month that's historically quiet, where traders roll contracts forward, not yank metal out. But this year, they stand for delivery en masse. Registered inventory hovered at 113 million ounces late November. By mid-December, it's drained to levels where conversions from eligible stocks barely stabilize it at 130 million. That's not routine turnover. That's a run on the vaults, where longs no longer trust the paper game. They see the open interest ratio at 244%, nearly 2.5 claims per available ounce, and they're pulling out before the illusion collapses. In a stable system, inventories buffer shocks. Here, they're evaporating, exposing how thin the liquidity really is. This drain isn't isolated. It's echoing through global chains. India's imports slammed 1,715 metric tons in October, 55 million ounces, or 7% of annual mine production in 1 month from one nation. November added 1,600 tons. December projections top 1,000, pushing 2025 totals beyond 9,000 tons, or 289 million ounces. That's a black hole, absorbing metal that doesn't recirculate. Families hoard it generationally. Recycling is negligible. And now, with silver formalized as loan collateral in Indian banks, a policy shift remonetizing it after 150 years, demand structuralizes. If 10% of eligible entities pledge, that's 100 to 200 million more ounces annually locked in. This isn't festive buying spiking temporarily. It's sovereign mechanics embedding silver into finance, pulling it from global pools permanently. Yet the silence from regulators amplifies the signal. No emergency statements from the CFTC, no LBMA alerts beyond buried rule tweaks. Media covers the 67 close as a rally, not the symptom of a deficit market where supply can't meet contracts. Global silver ran a 215 million ounce shortfall in 2025, the 5th straight year, while mine output flatlines at 830 million ounces. Recycling scrapes 180 million, but it's dispersed. Traces in electronics, films in solar panels, contacts in EVS. Extraction costs exceed value, even at $67. You'd need $100 to $150 to make urban mining viable, and infrastructure lags years behind. No quick fix. Geology sets the pace, and 72% of silver is byproduct from copper or zinc mines. Prices tripling won't accelerate digs tuned to base metals. Here's where history mirrors the fracture. In 1980, the Hunt brothers pushed silver to $50, but the system reset via rule changes and margin hikes, crashing it back. Manipulation worked because above-ground stocks were ample, deficits absent, and industrial demand modest. Paper overwhelmed physics then. Now, it's inverted. Deficits compound over half a decade. Stocks dwindled to 200 to 300 million ounces of truly free-floating metal globally. COMEX 130 million registered. LBMA 300 to 400 million, much allocated. Shanghai under 50 million. ETFs 600 million, but investor locked. The Hunt era had buffers. Today, none. What shouldn't happen in a sustainable setup? A lease of 128.6 million ounces from ICBC to JP Morgan in October, time to expire as supply gates slam shut, is unfolding as if scripted. That lease, 4,000 metric tons, emergency borrowing amid October's London shortage, where delivery delays stretched to 60 days from 2, and lease rates spiked over 40% annually. Borrow at that cost? Only if vaults are bare. JP Morgan's vault shifts, millions of ounces toggling between registered and eligible late 2025, halting delivery receipts in December, betray management of a crisis. They borrowed from China, the export kingpin, right before Beijing's January 1st restrictions. China controls 100 million ounces in annual production, exporting most. Quotas now secure domestic tech and solar needs, but strategically, it's leverage. Western green transitions crave silver for panels and EVs. China weaponizes the chain, cutting 20 to 30 million ounces from global flow yearly. Compounding it, LBMA's January 1st rule. No non-Roman lettering on bars, cereals, dates, or fineness. Cyrillic from Russian refiners. 5 to 10% of good delivery supply gets sidelined. Some Asian bars too. Sanctions suspended Russian metal since 2022. But this locks it out longer, forcing redesigns that take months. Liquidity shrinks precisely when JP Morgan must source replacements. Options? Open market buy, but COMEX's $130 million barely covers their $128.6 million need, risking exchange crisis. Chinese exemptions? Unlikely amid trade tensions. Beijing State Bank, ICBC lent, perhaps to watch the squirm. Default to cash? Shreds reputation, ignites counterparty fears, confirms physical unavailability. Extension? Terms could be punitive, political. No path avoids strain. If you've tracked commodity flows or worked in bullion, how does this January convergence look from your vantage? Share your read on the lease dynamics in the comments. Does it feel coordinated or just brutal timing? Interweave geopolitics and the break sharpens. China's restrictions aren't mere policy. They're a play in a broader contest where silver's role in military tech, guidance systems, missiles, electronics, makes it dual use. Export curbs echo rare earth strategies, forcing reliance or premiums. India, meanwhile, isn't just consuming. Its collateral policy revives silver's monetary ghost, weakening rupee amid inflation, hedging sovereign risks. Logistics buckles too. Hong Kong customs logged 644 tons from China to India in October alone. But with quotas, those pipes clog. The system loses control where chains intersect. Export hubs to import black holes. Regulatory tweaks to lease deadlines. Return to the price. $67 shatters 2011's $49.45 and 1980's $50, unadjusted. From $30 in December 2024, a 127% surge, outpacing gold, equities, commodities. Not speculation, survival. Suppression held at $20 to $30 for decades, capping via paper floods, shorts, smashes. Narratives dismissed it as industrial byproduct, no monetary heft. But you can't short solar demand or print EVs. Industrial pull, 600 million ounces yearly for tech, green energy, meets investment, 250 million. Jewelry, 200 million. Other, 175 million. Totaling 1.225 billion against 1.01 billion supply. The cap failed because physics intruded. Deficits drained stocks, now critical. Contrast with past crises, 2011 spike from QE fears, but supply responded. Deficits nil. System absorbed. Now, structural locks. Solar panels sequester silver for 15 to 20 years. EVs for a decade. No recirculation. Miners can't ramp. New mines need 10 to 15 years from discovery. Even primaries are scarce. The break? Where paper claims detach from metal atoms. Open interest at 244% to registered screams Ponzi. In stable eras, ratios hovered 100 to 150%, buffered by stocks. Here, no buffer. Demands hit simultaneously. JP Morgan's 128 million. India's 64 million more by year end. COMEX's ongoing 20 to 30 million in late December shocker early January. Over 200 million ounces clashing in weeks against 200 to 300 million available globally. This isn't abstract. Premiums at 17% in India. Dealers sold out worldwide. Physical trades $75 plus, while paper says $67. The spread is the fracture. Market admitting scarcity without headlines. Media tiptoe, regulators mute. That's a signal. In healthy systems, anomalies trigger probes. Here, none, as if exposure risks cascade. For those in finance or trading, how do you interpret this open interest ratio at 244% against historical norms? Drop your analysis in the comments. Does it signal an imminent reset or something else? Push deeper. The January 1st trifecta, China quotas, LBMA rules, lease expiry, converges like a vice. Symptoms precede. October's LBMA crunch, 1,000-ton order overwhelming, liquidity vanishing. JP Morgan's pivot to ICBC wasn't random. Insiders leak it as desperation. Behavior matches, vault maneuvers, delivery halts. If real, early January forces choice. Drain COMEX, collapse inventories, beg China. Geopolitical cost. or default, systemic shock. Even if rumor, circumstantial stacks. Timing with shortages, volumes aligning COMEX, LBMA stress, Hong Kong flows. History is mirror. Hunt brothers manipulated up, but crashed on intervention. No intervention now because fundamentals drive. Deficits, not speculators. System loses stability where interventions once reset. Now, they can't. As metals absent, geopolitics amplifies. China's trap? Lend, restrict, squeeze. India's policy? Remonetize, absorb. Logistics. Delays to 60 days signal pre-break. Military angle, silver and hypersonics, radars. Makes curbs strategic, not economic. The process unfolds non-linearly. Consequences first. $67 as floor, not top. Vaults bleeding. Premiums exploding. Causes emerge. 5-year deficits eroding stocks. India's black hole. China's chain control. Interlink. Solar boom locks silver long-term. EVs accelerate, while mines lag. Where does control slip? At the vault to contract nexus. Claims outpace atoms. Regulators avert eyes. If you're in the solar or EV industry, what's your take on silver's role in locking away supply for decades? Share your observations on chain disruptions in the comments. How's it hitting your operations? Scale widens. Global supply, 1.01 billion ounces. 830 mine, 180 recycle. Demand 1.225 billion. Deficit 215 million, covered by dwindling stocks. ETFs, 600 million. Untouchable without fund runs. LBMA's 300 to 400 million. Much pledged. Real liquidity? Under 200 million. January's 200 plus million demands? Unsustainable. Panic ensues if one overshoots. Prices parabolic, spreads 20 to 30%. Recycling myth. Inefficient, dispersed. No surge possible short term. Mining? Byproduct limits response. New projects? Decade plus. The break is multi-decade, structural. Compared to 2008 financial crash, liquidity illusions popped when claims met reality. Here, similar. Paper silver as derivative bubble. But unlike dollars, can't print metal. System fractures at that impossibility. For historians or market veterans, how does this echo the Hunt brothers era versus differing now? Weigh in below with your parallels or divergences. Why the suppression breaks this time? Military weave. Silver's conductivity in weapons, missiles, drones, comms, makes it critical. China's curbs, dual purpose, pressuring U.S. supply chains amid tensions. India's hoard, hedging instability. Logistics, export restrictions clog ports. LBMA rules strand bars. The loss of control, where global flows fragment into national silos. Price discovery realigns. Decades suppressed, now free. From $30 to $67, but true value? Infinite demand, finite supply. Industrial needs non-negotiable. Investment flees fiat. If you've dealt with physical dealers lately, what's the reality on premiums and stockouts? Tell us in the comments. Does it match the 17% India spike, or worse elsewhere? Endgame phases in. By January 7th to 8th, lease resolution. Deliver. Drain vaults. Default. Expose fraud. Or negotiate. Concede power. Either erodes confidence. COMEX March deliveries. Elevated open interest. If December's slow month drained 62 million, March could empty it. Halt trading. Lawsuits. Cash settle. Admit break. Physical premiums rule then. The system's in phase shift, from paper dominance to physical scarcity. No reset button. Deficits deepen, stocks vanish, demand structuralize. $67 marks the onset, not climax. The process grinds on, inexorable, as claims confront atoms. One last probe. If you're following geopolitics, how do China's restrictions fit broader strategies? Share your interpretation in the comments. Leverage play or coincidence? Silver opened above $68 on December 22nd, 2025, touching intraday highs near $69.50 before settling around $68.80. That's not consolidation. That's acceleration. COMEX registered inventories hold steady near depleted levels from the December drain, while physical dealers worldwide report premiums climbing to 15 to 20% in key markets, refiners extending lead times, and wholesale lots trading at fixed markups, unavailable at spot. India's year-end push adds another layer. Projections now firm at 5,500 to 6,000 metric tons imported for 2025. With December flows alone absorbing what remains of global liquidity, the gap widens further. Paper contracts trade freely, but actual metal changes hands only at escalating costs, confirming the detachment that's been building all year. This momentum carries the scars of October's crisis forward. Lease rates that spiked beyond 40% annually haven't normalized. They linger elevated, signaling persistent borrowing desperation. The emergency draw from Chinese sources, reportedly 128 million ounces, shifted to cover London shortfalls, now confronts replacement realities. China's January 1st licensing for exports isn't a minor administrative tweak. It gates 60 to 70% of global flows through state approval, prioritizing domestic solar and tech chains over external buyers. Russian origin bars, already sidelined by sanctions, face additional LBMA hurdles on markings. Non-Roman scripts phased out for new productions starting 2026, shrinking compliant supply precisely when vaults need replenishment. The convergence tightens the noose. No easy arbitrage from east to west. No quick refill from secondary producers. Track the vault signals closely. COMEX deliveries exceeded 62 million ounces this month, pulling from a registered pool that barely exceeds 130 million total. Conversions from eligible categories propped it up temporarily, but the bleed continues. Traders standing for physical rather than rolling, distrusting the paper overhang where open interest still implies over 2 claims per deliverable ounce. LBMA vaults report fluctuations, but allocated holdings lock much away. Free-floating metal for urgent needs contracts. Shanghai stocks remain guarded, customs data showing restrained outflows. The system sustains on dwindling buffers, where earlier eras absorbed spikes through ample stocks. Now, 5 consecutive deficits, 215 million ounces short in 2025 alone, have eroded that cushion to critical thresholds, perhaps 200 to 300 million ounces globally unencumbered. India's absorption amplifies the strain. Duty cuts to 6% unleash structural inflows, compounded by silver's new collateral status in banking. Removal of a 150-year monetary barrier, channeling household and institutional hoards. Imports that halved early year rebounded fiercely. Q4 projections pushing totals beyond initial forecasts. This isn't transient festival buying. It's embedded finance, metal entering and staying. Minimal recycling, generational holding. One nation's policy recalibrates global equilibrium, pulling ounces that won't return soon. Geopolitics threads through. China's controls secure leverage in green transitions. Solar panels, EVs, data centers devouring silver irreversibly, locked for 15 to 20 years per installation. Western dependence meets restricted pipelines. No coincidence in timing with lease maturities. LBMA adjustments standardize but effectively narrow acceptable sources. Premiums rising for compliant Western bars. Military applications, conductivity and guidance, radars, add strategic weight, curbs extending beyond economics. If you've navigated physical sourcing recently, how do current premiums and delays compare to October's peak? Share your dealer experiences in the comments. What spreads are you seeing and where? Deeper into the mechanics. Industrial offtake hit 600 to 665 million ounces yearly, non-substitutable in precision uses. Thrifting reduces per unit loads marginally, but aggregate growth, AI buildouts, renewable targets, outpaces. Mining yields flatline, 72% byproduct, unresponsive to silver prices alone. New primaries, decade-long horizons. Recycling inefficient, dispersed traces uneconomical, below $100 to $150 thresholds. The deficit compounds structurally, not cyclically. Contrast prior peaks. 2011 rode monetary fears post-QE, but supply expanded, deficits absent, system reset via interventions. 1980 speculation crashed on rule changes amid surpluses. Today, fundamentals invert. No buffers, demands locked long-term, interventions muted as regulators observe without alarms. The breakpoint, where physical claims collide with finite atoms, premiums the honest price signal media glosses as volatility. For those in green tech or manufacturing, how are silver costs impacting project margins now? Drop your insights below. Has thrifting offset enough, or are shortages forcing delays? Scale reveals fragility. Total supply barely 1.01 billion ounces. 830 million mined, 180 recycled, against 1.225 billion demanded. ETFs hold 600 million, but redemptions risk runs. Institutional allocations pledge more. Real availability, squeeze below 200 million. January demands, residual Indian year-end, ongoing COMEX, potential lease resolutions. Test that remainder. One exceedance cascades. Aggressive buying empties exchanges, premiums explode, liquidity fragments nationally. Price at $68 to $69 marks progression, not plateau. From $30 a year ago, 130% plus gains reflect discovery, suppression mechanisms failing. Shorts capitulated, major players flipping long, removing decades of caps. No artificial ceilings hold when physics asserts. Veterans of past cycles. Where does this differ from 2011 or 1980 in sustainability? Comment your contrasts. Why no quick reset now? Military geopolitical weave tightens. Silver's dual use in electronics. Hypersonics positions it alongside rare earths. China's playbook familiar? Export gates as influence. India's hoard hedges rupee, inflation. Logistics clog under quotas. Control erodes where flows silo. Global market balkanizes. The phase advances inexorably. Regulatory gates activate in days. Potential obligations in weeks. Outcomes strain uniformly. Source aggressively. Vault crises. Negotiate concessions. Power shifts. Or settle cash. Confidence erosion. Physical rules then. Spreads 20 to 30%. Paper secondary. If tracking Asian openings or lease rumors, what's your read on replacement feasibility? Share observations and comments. Coordinated restraint or mere policy? Process grinds forward. Deficits deepen into 2026. Stocks vanish further. Demands entrench. $69, not ceiling. Entry to realignment. Scarcity pricing without negotiation. System in transition. Paper to physical dominance. No reversal evident. The fracture propagates. Measured, but unrelenting. Silver trades at $68.76 on December 22, 2025. No pause. Acceleration confirmed. COMEX vaults barely hold after 62 million ounces drained in a dead month. Physical premiums hit 15 to 22% worldwide. Dealers ration, refiners delay weeks. India's 2025 imports lock in at 5,500 to 6,000 tons. Paper floats free. Metal demands escalating real cost. The fracture is now structural. January 1st gates slam shut. China's export licenses gate 60 to 70% of global supply. Quotas favor domestic solar, tech, military. 20 to 30 million ounces vanish from open markets yearly. LBMA's new bar rules sideline non-compliant stock precisely when vaults need refill. No coincidence. No buffer. Vaults bleed on. Registered COMEX at critical lows. Open interest still over 200% of deliverable. Free-floating metal globally? Perhaps 150 million ounces max. Against 1.225 billion demand and 6 straight deficit year. No reset possible. India's black hole embeds deeper. Collateral policy plus duty cuts equals structural absorption. Metal enters banks, households, industry. Never comes back. Recycling negligible. Generational hoards. Geopolitics locks it in. China weaponizes silver, like rare earths. Dual use for missiles, radars, EVs. India hedges rupee and inflation. Flows silo. Global market balkanizes. Price discovery brutal. 130% plus from $30. Past 1980 and 2011 highs. Suppression dead. Shorts capitulated. No artificial ceiling survives physics. Industrial demand 665 million ounces yearly. Solar panels lock silver 15 to 20 years. EVs a decade. Byproduct mining 72%. Won't respond fast. New mines 10 plus years. Recycling uneconomical below $100 to $150. No quick fix. History fails as guide. 1980 crashed on surpluses. 2011 absorbed by supply growth. Today, no surpluses, no growth, no intervention, only scarcity. January demands collide. Residual Indian pull, ongoing deliveries, potential lease resolutions. Over 200 million ounces in weeks against 150 million free. One overshoot equals premiums 25 to 30%. Exchanges empty, liquidity national. System in final phase. Paper loses dominance. Physical rules. Spreads permanent. Confidence erodes regardless of outcome. Aggressive buy drains vaults. Cash settlement exposes fraud. Concessions shift power. The break is complete. Deficits deepen into 2026. Stocks vanish. Demands entrench. $69 is not a top. It is the new floor of a world without illusion. If you track physical flows or industrial orders, what early January signals are you seeing? Share your read in the comments. How wide is the real gap already?